Hello guys, how are you doing? I hope your trading is going well and I'm happy to have you back on my channel. Today we are going to be talking about a very interesting topic, fair value gaps and inversion fair value gaps. Now I know that fair value gaps are what we learn when we have already found our feet in trading, but before I know that we are familiar with fair value gaps, so I will just brush over fair value gaps and we'll move forward to inversion fair value gaps, which is the main reason why I am recording this video. Inversion fair value gaps. Okay, so what is a fair value gap? First of all, a fair value gap is an area of inefficiency in the market. That is when there is a sudden movement in price and there was no delivery of either buy side or sell side within that range in price. So to break things down a little bit more, let us use this fair value gap here as an example. So fair value gap is actually a three candle formation, a concept. So the idea is that once a candle here is printed like this one, then there is a middle candle and then there is a third candle. If you check and the high of this first candle and the low of the next candle is not overlapping each other, which means that there is a both buy side and sell side delivery within this range in price, then you will know that there is a fair value gap. And traditionally, what the market does when there is a fair value gap is for it to reprice and deliver sell side first. As you can see, the market came back to fill this gap, to fill the inefficiencies, because according to the auction market theory, the market always delivers fair price to both buyers and sellers. So the process of the market coming down to fill this gap is called rebalancing. So you can call this fair value gap a buy side imbalance and sell side inefficiency, or you can just keep it simple and call it a fair value gap. So this is for a bullish fair value gap. Now over here to the right is a bearish fair value gap. So it is the same thing like the bullish fair value gap, but just that it is the opposite of it. In the case that we are still looking at three candles, and during the formation of these three candles, the first one, the low of this first one and the high of this first one is not overlapping, which means there was only sell side delivery. There was no buy week to close this gap. So once the market leaves this area, the market usually comes back to rebalance and deliver fair price to the buyers before taking price down. So in a bearish scenario, the fair value gap, once price comes back into it, it takes price down to continue to go to the downside. Okay, so that is what fair value gap actually is. It is all over in your chart. You can see it in your 1 minute time frame to your 1 month time frame. Like, since price is fractal, you know what I mean. So you can see it in every chart that you're looking at. So now let us go over to the main topic of this video, which is my favorite, and it is an inversion fair value gap. So watch closely right now. What is an inversion fair value gap? An inversion fair value gap is simply a fair value gap that has failed to perform its function as a fair value gap. which means it is now an inverse or an opposite fair value gap. Okay, and one important thing about inversion fair value gaps is that once price closes below a fair value gap, it becomes an inversion fair value gap. So in a bullish scenario like this one, if price fails to continue going up like this, like in this case price closed below a fair value gap, it is now an official inversion fair value gap, and price will use this level as a resistance to continue to send prices down. What I would normally do is I'll have my consequence encroachment line, because that is my favorite place to take my trades from, the middle line of inversion fair value gap or the middle line of fair value gaps. So the interesting thing about inversion fair value gaps is that it offers you a confirmation entry. Okay, it offers you a confirmation entry. That means you don't need to chase price. You just need to spot your fair value gap first of all, and then patiently wait for price to close above or below your inversion fair value gap. So look at the bullish scenario for an inversion fair value gap, and this is my favorite because I like to see this on down days, on days that the market is trending down. All right, so what I usually do is I'll wait for a sweep of liquidity of a higher time frame. So this is what validates all inversion fair value gap. Once there is a sweep of liquidity first of all here, then you will start looking to take buy positions once price starts going up and start closing above fair value gaps to make them inversion fair value gaps. So this right here is a fair value gap that was disrespected when price closed above it, and once price closed above it, it started going upwards. All right, now an important thing to note about this strategy is that it does not work all the time that you open your chart. Okay, you have to work with time, and it is time that puts this strategy in your favor. I mean, you can come to the chart and see it working all the time. Yes, it does work, but in order to increase your accuracy, in order to increase your strike rate, you have to trade with time, and it is time that puts the odd in your favor when you are trading inversion fair value gaps. Okay, so for the sake of references, I'm going to point to the time zone in my trading view. That's on the lower right corner of my trading view. You will see that my time is set to New York time. So I advise you to set your time to New York time, because the algorithm that delivers price runs on the New York time. So you work with New York time as a trader, and ignore whatever place on earth that you are trading from. Just align yourself with the New York time and you are good to go. All right, so uh, maybe I should just look for an example here. So sorry I did not mention about the time in particular, but I usually trade the New York morning session. So on a bullish day, I expect price to drop first of all. Then once I see price dropping and it takes out an initial low in form of SSL, that's sell side liquidity, I will wait for price to start closing fair value gaps that it's created on the way down, to turn them to inversion fair value gaps. And once I have my inversion fair value gap, this is how I frame my long positions. I will take my trade from the high of the fair value gap, or from the consequent encroachment of the fair value gap, and target this high that I'm seeing right there. So this is my model that I trade every day when I'm on the chart. So before I end this video, I think I should just show you a quick example of what I mean on the chart. Alright, just one example is okay. Just one example is okay. What is the time here? This is 10:15. Okay, so I think we should work with this one right here. So this is Tuesday. This is Tuesday, the 19th of November 2024, and this is 8:45 a.m. to 9 o'clock a.m. Of course, this is a 15 minutes time frame, so that is what we are looking at right now. So um, just to quickly demonstrate what I showed you, time of the day is very important, because this time is when economic events are being released, like the CPI, PPI, you know, unemployment claims news that usually drive the market down. All right, so this right here is the sell side liquidity that was taken. That's the SSL. So what happens right here is that once price took out this SSL, I have started to look at the fair value gaps that was created when price went to take down this sell side liquidity. And if your eyes is right, or if your price is working right, you will see that this is the fair value gap that was created when price went down. So our eyes will be on this fair value gap. So what else am I expecting price to do? I'm waiting for price to close above this fair value gap right here, so that I can frame my buy positions. And it was validated when price closed with this candle right here. So once I see that price has closed with this candle right here, I know that price has flipped, that this fair value gap, instead of sending price downwards, it will now be acting as an opposite of a fair value gap, which is an inversion fair value gap, to send price upward. So my inversion fair value gap comes in, and I will frame my long position from the consequent encroachment of this fair value gap, and I'll have my stop loss somewhere underneath it. Then I'll be targeting relative equal highs, like this high. I'll be targeting highs like this high, this high, and this high. So as you can see, it was a very quick and nice trade, and it will be done before lunch or during lunch. This is 1 p.m. So this is the model. This model right here is what I demonstrated here. Okay, it is what I demonstrated here. So sell side liquidity taken, inversion fair value gap was formed when price closed above a fair value gap, and you take your entry from the midpoint of the inversion fair value gap and take your profit in the next swing point. So I don't think there is any other thing for me to touch in this video, because I wanted to make it a short and interesting one. You are free to go back test on your chart to see what works and what doesn't work for you. This is just me sharing to you what I use every day to make my money on the chart. So if you have any questions, you can drop it in the comment section, and I will be there to assist you. If there is any video that you want me to make also, you can let me know so that I will make the video for you. Alright, so that will be all for this video, and I thank you for watching. Please subscribe to my channel. I hope to see you next time when I post a new video, and until then, trade safe and stay safe. Bye bye.